Hello everyone, so let's start our first chapter on the topic of the building blocks of risk management. In this chapter, we'll be covering a number of learning outcomes pertaining to financial risk management. We'll be talking about the concept of risk and we'll be comparing it with risk taking. We'll be describing the building blocks of risk management process and also identify the problems and challenge that can arise from risk management process. We'll be discussing the tools and the procedures that can be used to manage financial risk. It includes both quantitative and qualitative risk measures. We'll be talking about expected and unexpected loss. We'll be discussing the relationship between risk and reward. In the end, we'll be talking about key classes of risk and we'll then discuss how we can aggregate risk exposures. So let's start our discussion with this very critical concept of definition of risk. So, of course, risk is part of the overall financial risk management, but to understand the financial risk management, we have to first understand what is the theoretical definition of risk, what risk is all about. So when we talk about the definition, it has two broader aspects. We define risk as uncertainty or volatility around expected outcomes. So we have to discuss two things: what is uncertainty or volatility and what is an expected outcome. So uncertainty or volatility is something that we'll keep on discussing again and again in the curriculum of the financial risk management program, but it's generally denoted by sigma. So the uncertainty or volatility is actually something that we keep seeing in the financial market. So if you have ever seen a graph of a financial market, of an equity market, you may have seen that it may move something like this. So these are returns, or what we may also refer as capitalization, and then there is time. So you can see that on an overall basis it's increasing, it has an increasing trend, but you will notice that it has an increase there, but then it comes down, then it increases, and then it comes down. Of course, it's a hypothetical scenario, so there's a bit more ups and downs as we don't generally see in the market. But what I'm trying to explain is that in the market there can always be volatility. You will see the market going up and you will see the market going down. Of course, it has some correlation with the economy as well. But the thing is that if you have invested $100 million in the financial market, in 1 year it can go up to $110 million. And when there is a recession, when there is, there's volatility in the market, it can go down to, let's say, $80 million as well. And this is what volatility is all about. This is the fluctuation around mean. If we define it statistically, we define it as fluctuation around mean. So whenever we are investing in the financial markets or whatever business we are doing, there is a chance, there is an uncertainty, and there is a volatility around our expected outcome. So when we talk about financial market or investment in the financial market, we are generally recommending to returns or return series. We are more interested in knowing what sort of returns we'll be having, what sort of outcome we'll have. Will we be making enough money in investing in this particular financial market or not? So that can be referred as an expected outcome. So we can say that we are expecting an annual return of 10%. So that can be our expected outcome. Anything that we are expecting to happen during a certain period of time, we can refer it as expected outcome. We'll talk about an outcome when we'll go into our quantitative section, but more broadly, an outcome is something that we are expecting to happen. So for example, we are saying that we have invested in the capital market, in the equity market, and we are expecting an annual return of 10%. Of course, this expectation would be based on some historical scenario. So if we have seen in a particular market, there is a historical return of 10% during the last 10 years. So based on the history, we are expecting that in the next year, when we have invested, let's say $1 million, we will be getting somewhere around 10%. But the thing is, because of this uncertainty, because of this volatility, our investment can go both up and down. So if there's a return, if there's a chance of getting 12% return, there's a chance that we may also lose 5% of our investment as well. So we can get $1.12 million, but there's a chance that our investment goes down to $2.595 million. So there's an upside risk and there's a downside risk. So volatility can go both ways. It can be positive and it can be negative. But as a risk manager, we are more concerned about the downside risk. We are more concerned about knowing what is the possibility and what is the way, or what are the options that we have to be able to avoid this scenario. Of course, if it goes up to, let's say, 15% to 20%, we will be more than happy if we are having an upside risk, if our expected outcome is more than what we initially expected. But we are concerned about the losses. So risk management is more about managing the risk, the negative outcomes that we can face while investing in the financial market or while operating in the banking sector in the corporate world. Now let's talk about the comparison of risk management with risk taking. So there's this famous term that you may have heard, that the higher the risk, the higher the return. So it says that if you have to achieve higher returns, you will have to take higher risk. So if you want to get a return of 5%, you may just have to bear a volatility of 2%. But if you have to increase it from 5% to 10%, you may have to increase your risk by 5 times to about 10%. But the fact remains same, that if you have to attain higher returns, you will have to take higher risk. And hence there is a natural trade-off between this risk and return. Now we can discuss this risk and return in an example of investing in the bond market and the stock market. So when we talk about bond market, we may say about government bonds. These are, for example, the bonds issued by the US Treasury. Now, if the US Treasury is issuing a bond or a T-bill, Treasury bill, which is generally of a shorter term, you may get a return of 1% to 2% based on whatever the policy rate are there in the market. So you are getting a lower return, but you are sure that the government is not going to default and you will get whatever principal you have, and you will get the desired return, which would be on a lower side because of the surety that you are getting, but you will certainly get it, and hence the returns are on a lower side. But if you want to invest in the equity market, there is volatility, that if you have invested your money, if you have invested $1 million, you may not get the interest, you may also lose the principal. As we just discussed, that we can also lose our initial investment as well. But in order to take that sort of return, like if you are facing that sort of risk, you can also attain a risk as high as 10%. So if you are someone who has a lower risk profile, if you are not willing to take that sort of risk, you can invest in the bond market. But if you want to desire, or if you want to take more returns, you can invest in the equity market. So basically, risk management is more about managing the risk given the desired risk appetite. So basically, it's more about what sort of risk are you willing to take. Are you a risk taker? Are you someone who is in his 20s, who has just started investing, or are you someone who is just about to retire and who wants to have more safer options to invest? So based on the risk appetite, you can decide your risk management policy. And risk taking, it's more about accepting the additional risk while attaining that additional return. So if you want to increase your return from 5% to 10%, do you want to increase your risk from 2% to 10% or not. This is something that will define your risk ability and your risk management strategies. Now let's talk about some of the loss categories. So in the earlier example, we discussed that we can have some losses there. We can attain our objective of getting 10% return. We can also book losses as well. So in risk management, losses play a significant role, and there are a number of categories when it comes to losses. The first category is expected loss. So expected loss is a loss that we consider as an expectation from the entity in normal course of business. So this is something that if there's a bank A which is investing in the small and medium enterprises SME market, they may know that in the SME market the interest rate that they will be getting are higher, but they will also be booking non-performing loans or losses of about, let's say, 6%, which is usually higher than corporate, which has lower returns as compared to SME sector, but their losses would be limited to 2%. So expected loss is something that the business expect in normal course of business. This expected loss is actually a function of three factors: probability of default, loss given default, and exposure at default. So probability of default is the percentage that you are expecting that can go bankrupt or that can be booked as a loss. So for example, if you have invested $1 million, or if you have given loan of $1 million in the SME market, you may expect that the probability of default would be 2%. Only 2% people will default, or we can say 6%. So in this particular case, considering an investment of $1 million, if we have to calculate expected loss, we'll be putting 6% here. We'll be putting exposure at default, which is the amount that we have given, which is $1 million. And there is concept of loss given default. Loss given default is the amount that you may not recover. So when it comes to financial transactions, there is a chance that there will be some recovery from the losses. So if there is an SME which has gone bankrupt, which is not paying your money back, you may have some collateral, you may go to litigation, and you may recover some amount of money, and that amount of money will be covered in the recovery rate. So LGD is considered to be the amount which will not be recovered after the litigation, after the liquidation of the collateral, after exploring all sort of options that you have to recover that particular amount. So let's say if we assume the LGD to be 50%, if you apply that, you will be getting your expected loss. In this particular case, the expected loss would be $0.03 million. Now the second category is the unexpected loss. This is the kind of loss that the entity could lose this is the kind of loss that the entity may face in excess of their average or expected loss. So if they have used this methodology to quantify their risk, and they were expecting a risk of $0.03 million, but their actual loss came out to be $0.1 million. So the differential between $0.1 million and $0.03 million, which would be $0.07 million, would be your unexpected loss. So an unexpected loss is the loss that is not as per normal course of business, that your model didn't predict, that is excess of the average expected loss that you may have predicted using your financial models. The third category is the unknowns. The unknown is considered to be the tail risk event. When you talk about normal distribution, a tail risk is an event where there are more losses than usual. So these are the risks that you don't know can happen, and once they happen, the quantum or the impact of the losses would be way higher. An example is technology disruption. For example, BlackBerry used to be a market leader at a time, but with the invention of the touch screen, their technology went outdated and ultimately they had to close their business. So one, they did not know that technology disruption could happen. It was unknown, and they did not know that it would be at such a level that BlackBerry would be totally out of the business. So you are not aware about the risk, what sort of risk that can happen, and you are not also aware about the impact that it can bring to your business. The number fourth loss is known unknown. So you know that the risk can happen. You know that there in theory a particular risk can happen, but you don't know about the impact that it can have on your organization. For example, the COVID-19 pandemic. So under the operational risk regime in the Basel framework or in any other framework that we have for risk management, a pandemic was always mentioned, that a pandemic can happen and it can bring a lot of uncertainty, a lot of volatility, a lot of losses to the financial markets and to the corporate in general. But we did not know what sort of pandemic COVID-19, a pandemic like COVID-19 could result in. It impacted all sort of risk, it impacted all sort of markets, and it had such a huge impact that we did not actually know that can actually happen in the market. This particular known unknown is also referred as night game uncertainty.